You and I have no control over the movements in the stock or the bond markets or interest rates or various things regarding the economy. The good news is from which account you take income and when, well, you and I have complete control over this. And the account selected and the amount from which account to take income and when could have varying tax impacts for you both now and down the road. So I'm Oliver Klopsky, Director of Wealth Services and Wealth Advisor at Sweet Financial Partners, located in Fairmont and Jackson, Minnesota. We specialize in working with high net worth people who are at or nearing retirement. We believe that everyone has the right to realize that their dreams are possible and use this as the focus when working with you and helping you plan for the future. So at the end of last year, I sat down with a new client of the firm and they had done a Roth conversion earlier in the year. And it was done with good intentions and made sense with the information known at the time. So as it turns out, during the year and following the Roth conversion, their situation had changed. Their income was much higher than they anticipated, which is a great problem to have. And with how the markets performed in 2022, which for most stocks was negative, the value of the Roth account was less than the Roth conversion amount. So the question for them was, now what? So they had done a $30,000 Roth conversion. That Roth conversion, that the value of that Roth account was now worth about $25,000. So they were going to be reporting on their 2022 tax return $30,000 of taxable income, even though that asset was not even worth $30,000 anymore. It was worth $25,000. So as it relates to the question here, can you undo a Roth conversion? The answer is no. So if you want the short version of the video, you can stop here, but I would imagine most of you want more context. So let's continue on. So let's first define a Roth conversion. A Roth conversion, you're taking money out of a pre-tax account and moving it to a Roth account. Once you move it to a Roth account and meet certain specifications, certain criteria, it's going to be tax-free forever. So the process of doing a Roth conversion, go from a pre-tax to a Roth, that's a taxable event. You're going to pay taxes now, but tax-free forever. Ideally, when you do the Roth conversion, the value of that Roth over time grows, and that's tax-free growth forever. But in this case, for the situation I just outlined, what happened was the couple was targeting a certain income, federal income tax bracket to be in. And with the change in income, they were in a much higher tax bracket. So then they were paying more tax at a higher rate than they ideally had hoped for. Plus the value was down, with most asset classes going down in 2022. So the question is, could you undo that Roth conversion? You say, wait a minute, let's put it back the way it was. And again, the short answer is no. And it's a question we often get. And think of it, and I think part of the reason why we get the question a lot is you used to be able to undo or recharacterize a Roth conversion the way the rules used to be. So think of it like a mulligan in golf. So in the outline, or in the situation I outlined with this client at the end of last year, I could have said, well, if it was several years ago, yeah, we could undo it. You get a mulligan and we'll move on. But now we can't. So why are people doing a Roth conversion? Well, they have room in a certain federal marginal tax bracket. So at this point, we know that tax rates are going to rise in 2026. If Congress doesn't act, tax rates in 2026 are going to go back to where they were in 2017. So if someone's looking at their tax situation now, tax situation in the future, and say, hey, I want to pay taxes at this rate now, because I know my tax rate is going to be higher in the future. That's why a Roth conversion, again, converting from a pre-tax account to a Roth account, may make sense. So think of it as like a hedge against future increase in tax rates. Roth accounts, don't have required minimum distributions. If your own Roth IRA does not have a required minimum distribution, where a traditional IRA, a pre-tax account, the rule is right now 73. If you're 73, you have to take money out. It's taxable unless you give it to charity. You get Roth conversion. If you have more in a Roth, potentially less Social Security income, subject to tax, subject to income tax. The other question we get a lot, I'll throw this in here that we want to be careful. RMDs, required minimum distributions. They cannot be converted to Roth. You can move it to like an individual non-IRA account or a joint account, but RMDs, required minimum distributions, cannot be converted to Roth. You can do your RMD plus do a Roth conversion. Your RMD would be taxable, and so would the Roth conversion. But that a dollar amount that came out of the IRA as an RMD, that cannot go to the Roth account. If you do more than your RMD, you could move that amount over and above the RMD. That could go to the Roth. So be careful on that. So let's go back to the story at hand here, the situation. So now what? So let's say in this case, the $30,000, let's say in 2022, it was designed to fill up the 24% federal marginal tax bracket. But now, if we add up all the other income sources, they're going to be the 32% federal marginal bracket. So again, as I mentioned, not quite as designed. So at the time we met, we were still in calendar year 2022. So we could do certain things, but if we're looking back, and let's say we were meeting in like January of 23 and we're looking back at 22, then you can only do certain things. The things you can do are less. So what could we do, or what did we do back in 2022, because we were still in that calendar year? Well, charitable contributions. Does it make sense to give more to charity in a certain year? Maximize pre-tax qualified plans. Taxable income is a little higher than you want, so you kind of need to offset a Roth conversion, as odd as that sounds. Maybe you could put money into a pre-tax, like a plan at work, if you're eligible. Health savings account, if you have if you qualify with a high deductible healthcare plan, you could put money into an HSA. Maybe there's like a deferred comp plan at work that you could take advantage of. So those were several things that they could do, like charitable contributions. That wouldn't work if we were in 2023. You can't make a charitable contribution in the current calendar year that would be counted for last calendar year. Whereas like if you want to make an IRA contribution, which in this case, income would be too high to qualify for an IRA contribution, but let's say someone did want to make an IRA contribution to help last year. If you could do that in the current year, like at the beginning, prior to April 15th, 2023, you could have made an IRA contribution that would qualify for last year. So if things change, your situation changes, it's really important to identify and meet with financial advisor, collaborate with CPA to try to do things in that calendar year. Because once you get to the next calendar year, you become very, very limited on what you can do to try to help the tax situation. So one of my colleagues here at Sweet Financial, Amber Knipp, she did a video earlier this year called 8 Questions Every Couple Should Ask Before Retirement. And it's a nice tie-in to this topic, because after all, we want to focus on controlling from which account to take income and when. That's the thing you ultimately control.